8:26 for all the reports of people watching. So somebody's watching, because there's only 2 people here. That's fine. Not a bad idea, but we do a dollar value LIFO one. And so we've got 2010 to 2014. We have the end of the year inventory. We count the inventory, right? And value the end of the year prices. And then you're going to estimate what LIFO inventory would have been based on that using the price indices. And they've got price index, where wholesale price index or something they're using, or just on their specific products. But anyway, so we've got those. So I think what I'd do if I were you guys, or you want to just do it real quick and then I'll do it with you. Maybe that's better. We're doing 8:26, folks at home. Go ahead and work it real quick and then we'll see if it's useful to go through it. Real quick. Pretty quick. That better. Natural light. You get a lot of it.
Nice out today. A nice slow watch here.
Yeah.
Nice.
It'd be nice and clean. Clean and everything set. Grass is already in.
He copied down the right numbers.
They're making you guys concentrate. They're lights there out the window. Somebody in a Kroger shop, or a Kroger parking lot, listed.
Yeah.
Shot the police officer.
I'm on 60. I'm from East Hill.
Crazy.
I think a bus got rented on Newburgh a little bit ago.
Yeah, it did.
That's what it looked like.
Not funny. It wasn't funny. It wasn't funny.
Yeah, I was walking by. I couldn't tell because the bus looked like it was damaged at all, but that car was pretty bad.
I think the bus was fine. It was just.
Yeah, I think the car like went like up under it almost.
Yeah. That would be annoying too.
I didn't see an ambulance.
There was an ambulance, fire truck, and multiple police. Because I was walking here at like 2:30 or so, and I saw like all the ambulance and police over there.
Then I must have missed that because I went to go get coffee, and I just saw the car getting towed.
Oh yeah, you must have been there after that because I saw him like putting somebody on a stretcher over there.
Yeah, well, that's not good.
Yeah, it was. I'm 100% sure it's whoever was in the car because the front of it was wrecked.
Yeah.
Day in the stock market today, almost 300 points. Covered most of the loss.
Longer when you copy down the wrong numbers. I was looking at it, I was like, this seems so, yeah.
Seems hard when it's not.
I was like, this seems familiar, and then I looked, and it was the same, I copied down part of 85.
I've done the increases right, but I'm confused as to why you use the 1.05 for all the decreases. You use the same.
Okay, all right. So let's just look at what they did here. You guys use the answer book sometimes?
Yeah, that's why I went and checked. Now I saw they use the same factor.
And I don't necessarily like the way they do the work, but if there's a variety of ways you can do it, whatever works for you.
Yeah, their work is sometimes like absolutely throws me off. I look, I have the same answer, but they'll be completely
Fine.
off.
Yeah. So anyway, the base year was 2010 rather. and 70 divided by 1 is 70, of course, it stays 70. So the inventory at December 31st, 2010 is 70, right? Base year. 2011, 90,300 divided by 1.05, you got 86, did you?
Yep.
So we got a layer of 16. So what we do is we take the 70 plus 16,000 times 1.05, right? So okay. Then here they show it in doing it, right? 70 times 1 and 16 times 1.05 is 86. Then the next one goes down by 4, it looks like.
Yes.
Right? So if you go down by 4, I calculated,
Originally,
right? You're going to go back into the most recent one, last in, first out. So you would have sold 4 of this 16 here. You guys with me?
Yeah.
Okay. So you got 12 left. So what I've got is 70 from the base year and 12 from 2011. I have no layer from 2012. I didn't do it. You guys with me? Okay. So, all right. So then we go down. Look what they did. They got 70, I mean, at base 1, and then 12 at 105. So that makes sense. Okay, then we add a new layer. The next time it must be 82, 88, I guess, huh? Right?
Yeah, so 1 by 6.
Yeah, so we've got 105, 6 divided by 1.2, that's 88. So we have 6 more over the 82 from the year before. So now that's going to be a new layer at 1.2, right? We keep the 70 at 1. We keep the 12 we already had at 105. There's none at 116, and we're going to have a new layer of 6 at 120. And that's what we do. Here it is, 70 at 1, 12 at 105, 6 at 120. Okay, then the next year, what happens? We got another decrease. Now, when we decrease, which ones are going first? All the ones at 120 are going to go, right? That was 6 of them. Okay. See why that would go? It's last in, first out. So that layer is gone now. So there's no layer from 14 because we declined. There's no layer from 13 because we just got rid of it. No layer from 12, right? Because that was a decline year too. So all we've got is the base layer at 1, and we're going to dip a few more again, right? There were 12 left from 2011, weren't there, in base year dollars. And we're going to drop off 2 of those, I guess, right? 8 dropped down, and we lost 6 from 2013 base year, and we're going to lose 2 more from 2011, which will leave me with 10 from 2011 at 105. I think. Is that right? Remember it right? Yeah, there it is. So 2014 is the base layer, 70,000 at $1, right? $1 is $1 in the base year, of course, and then 10,000 at 105, right? 10,500, 80,000. Did that kind of clear it up?
Wait, can you repeat that? I was trying.
Okay, there's 70,000 left. So what happened in that year is when we took the 100,000 in 2014 and divided by 1.25, we get 80. That's 8 less than the year before. So we got to get rid of 8. So we get rid of the layer from 2013, which was 6,000 base dollars, right? So there's no layer from 2014 because we declined. There's no layer from 2013 because we just got rid of it. The 2012 was negative, so there was no layer from that year. 2011, we had a 16 layer, but we already got rid of 4 of it, so it was down to 12, and we need 2 more now.
Yep.
You get rid of 6, and you need 2 more, okay? Make the 80.
Wait, let's see the most recent layers.
So last in, first out.
So you would do the 6,000, wouldn't you? So 6 times 1.2.
Well, 6 is gone. That one's gone.
Why is that one gone?
When you lose it, because it's last in, first out. So we sold everything we bought in 2014. Right?
And more.
And we sold stuff from 2013. 6,000 in base dollars has gone from 2013 because we had a 6,000 layer. So that layer goes first, right?
Yeah.
First you sell the current year stuff, then you sell the year before. It's just LIFO, right? Just keep it straight in your head. Then we go to the year before that, the year before that.
So that was the 16.
Yeah, so we that 8 that it declines here, right?
8 times 1.05.
Well, not all. No, the 8 that's gone. Well, there's 8 left. You're right. The 8 8 that's left will be at 105. And the reason is, right, is because, or is it 10 at 1 point? 10 at 1 point.
Oh yeah, 10 at 1.05.
This 8 here that we went down is the 6 from the previous year in base year dollars, right? And then there was nothing for the year before that because it was a negative year. There was 16 from 11 to begin with, but 4 of it got used up in 12, right? So it was down to 12, and now we've used up 2 more.
So it's down to 10.
Now it's down to 10. Is that clicking?
Yeah.
And here we've got
There was
the base year, 70 at $1, right? And 10 at 105, right? Add them together, you get 80,500. So just always drop off the most recent stuff and keep working with that, okay? So if they deplete their inventory, obviously, keep the old ones, which is going to make your inventory lower, of course, okay? So that's good review. Oh, good. We're good? Good. Okay. Let's do, kind of fun to brain teasers almost. Inventory errors. One that you were talking about is 11. 811. Did you work that one? Is that the one where today you were mentioning current ratio or doing you do anything with that?
Yeah.
We do one of those. 811, good one.
Yeah, I worked that the other day, but I'll do it again.
Okay. Let's try 811 everybody. Buddy, all 2 of you. And all 100 people at home. Yeah. Sure. People that don't have any.
Wait, P811 or E8?
E11.
Okay.
Is that the one you did? Or?
Yeah, I did like most all the E's.
Okay. P811 is the dollar value LIFO one. This chapter, the problems with the belt likely exercises. It's not really much longer. So what you want to do is calculate your current ratio here, right? And then after each one of these, you want to recalculate it, right?
Yeah.
Compute current ratio, recompute after corrections are made. Oh, it's after all of them are made. Well, what amount will income before taxes be adjusted up or down to? Okay? Can we change? Can we change? Right? Really pays to crank through 11 of these, doesn't it?
So if they received and recorded an invoice, that would mean like they marked it as payable.
Yeah. How would you record? What would the German?
Wouldn't it be inventory and accounts payable?
So,
But it'll say that they like didn't include it in inventory.
yeah. So you've got the purchase recorded, right? But then you didn't include it in your inventory count. So what happens? You write your inventory down, right, making it understated.
So
But the payable still
what would
recorded.
it, the debit
right?
would be purchases?
So what you could think about it is this. Well, is it periodic or perpetual?
Doesn't say, it just says if they received and recorded an invoice, but the goods were not included in the
And would it really even make any difference? That's a question to ask yourself too. Would it make any difference in the ultimate outcome of this periodic or perpetual? So you might record it a particular way, but in the end it might give you the same result. Always think of it like this. Got a while since we wrote this down, huh?
But that would throw it off the.
And I might ask questions like this too. What's the impact on assets, liabilities, equity, revenue, expense?
Yeah, I was like, I was
cost of
thinking
goods sold,
you should do
whatever.
more of that than like the ratios, doesn't it?
Well, and the ratios are just a subset of that, right? Working capital is just current assets plus current liabilities, right? So it's part of it too. So those ratios are based on what's in the statements, right? Financial statements. So, and cost of goods sold is one of the expenses, right, guys? Okay. The cost of goods sold is beginning inventory. So you can always use this. You can always break it down.
But like what I'm saying is for like the A equals L plus E, like for that problem, it's saying that your payables went up, so your liabilities went up. But I don't know what the debit would be, how that affects it. Because if you have to record it in inventory, but you recorded a payable.
Well, what happens though? Think about that. What happens if you go to one or the other? That's probably a good thing to talk about. Let's say that you debit purchases when you buy, and credit accounts payable. That's what the transaction was. Or you debit inventory, and you credit
Still
accounts
current
payable.
asset, it's increased.
Yeah, what's going to happen? If I do it this way, what happens is I have more purchases, right? And by the way, was that a proper? It was correct to record it, but they did not include it in the inventory. It should have. So it was.
There was one that shouldn't have been and one that should have been, I think.
Okay. Well, let's do one where they recorded it properly, but then left it out of inventory. Okay. So purchases would increase, which would make available go up, which makes what? Okay. And then the ending inventory, you left it out. Ending inventory would be too low, right? Is that correct?
Yeah.
Okay. So available goes up the way it should, but then ending inventory doesn't have it in there, right? If you had increased ending inventory, your cost of goods sold would have been right. Your available would go up, and subtract a bigger number. So what that did was it made cost of goods sold too high, right? So that's if they do it this way. Now let's try it this way. So that would be periodic, right, guys? Periodic. Let's see what would happen if we did perpetual. Okay. We would have had correct beginning. We wouldn't. We recorded it by debit to inventory. We would have had the right purchases, right? We would have had right available. Is that correct? Is that right? Okay. And then the ending inventory would be what? Too low, right? Because you failed to do this. Is that right? No. You'd record it, so it would be included in the inventory. It's in the purchases. It's in the inventory correctly. But then if you didn't include it in the inventory, your inventory would be too low. Do that right? So that would give me cost of goods sold that are too high. Same deal, right? Yeah. So either way, you get exactly the same error, right?
I was just
And assets are, and what's going to be wrong, by the way? Cost of goods sold either way is going to be too high. Net income is going to be too low, which causes equity to be too low because we didn't count the inventory. Inventory is too low. Ta-da. And there's nothing wrong with liabilities in that case, right?
What was confusing me was what the debit would be because I didn't think they considered it a purchase yet. Since like I remember reading at the beginning of the chapter like the transfer of the title. So like the title.
Well, yeah, but if you would never record a purchase invoice until you receive the goods.
Well, but this is what they're doing. They're like recording it and they haven't received them yet.
Well, maybe not. Maybe they received it and they just failed to put it in inventory. Is that what happened? Or did they record it too early?
Let's see.
Those are different things. They might have recorded it too early, and if they recorded it too early, that's a different problem. If they made either one of these journal entries, then they should not have made it.
Let's see.
Now you got a different problem,
Yeah,
right?
for example, like the second was like they purchased 15,000 worth of goods, shipped FOB destination. They received and recorded the invoice, but did not include them in the inventory.
But have they received the goods?
No.
Oh, well then their inventory is correct. It's a whole different story, right?
Their inventory is correct. And yeah,
their inventory is correct, but their purchases are too high.
Yeah.
Okay, so let's go
So
through
you
that.
wouldn't include.
So what they did one of these, right? And should not have.
Yeah.
You with me?
Yeah, that's what I was confused about.
Okay.
The fact that it's saying that they like recorded and received it, but they didn't put it in inventory. So.
And they should not have recorded an inventory.
No.
Because they haven't got them yet.
Yeah.
Okay, so this way will drive you nuts, right? Let's give this a shot then. See what that one looks like. All right. So if they did debit purchases and should not have, they have overstated the purchases, right? They've overstated, did I write? The available, right? This is overstated, this is overstated, this is correct, right? So you've overstated cost of goods sold. It's having just the opposite impact. That's what we had available. So your cost of goods sold would be too high, net income is too low instead of too high, right? Equity is too low, but it's a little different though, because what's the other piece that's wrong? The inventory is okay, what's the other piece that's wrong? It's got to be liabilities, and how are liabilities too high? When you credit accounts payable, you should not have, right? But it would end up in cost of goods sold.
Yeah, that's what was throwing me off. I just didn't know how to handle it. The fact that they did the inventory right, but then they recorded the invoice and shouldn't have.
Should not have.
That's what I was thinking. If they recorded the invoice, wouldn't they have debited the inventory and
periodic, the debit would be the purchases. So let's try perpetual. This one's perpetual down here, right?
But that's what I'm saying. If they recorded it, makes it sound like they already put it in inventory, but then it says they didn't include it.
Oh, I see. It makes it sound like
so
they did.
yeah, that's what was throwing me off.
Well, you wouldn't count it if it's not there, though, even though you had recorded it.
But since it's saying
if you recorded it on your perpetual record's just wrong. So now their beginning would be okay, right? Their purchases would be okay, I guess. And their available would be okay, I guess. That's wrong. Beginning would be okay. If we recorded debit to inventory, we'd make an adjustment to take it out of inventory now. Actually, if it was perpetual, your beginning inventory would have been fine. No, I take it back. Your purchases would be too high to make your available too high. You'd still have to put it in there. And then when you make your ending inventory correct, it's the same thing. You make your ending inventory correct, you have to be overstated. Just wouldn't make a difference between the two. Because you would have debited inventory, right? If you debit inventory, what do you have to do to fix it if you don't include it in the inventory? You got to credit it, which is debit cost of goods sold. So you end up with too much cost of goods sold either way. Without adjusting entries. Does that make sense?
I'm confused on that. It's the fact that it's saying they recorded it, but at the same time it says they didn't record it.
It drives you crazy. Yeah. They recorded it in a journal entry. They did not count it and include it in.
So it's included in purchases, but not in ending.
It's not in the inventory count. They don't put it in the inventory count. When you price the inventory out, cost it out, you'll be correct in this case you'd be correct on the count. And when you're going to adjust your inventory to that count, right? The dollar amount of that, right? The count, the prices, right? The cost. You'd adjust to that amount, wouldn't you? Okay, so by not including it in the count, and you shouldn't have, you're going to have your inventory correct. But because you recorded too much purchases, you're going to have your cost of goods sold too high, right?
Yeah.
Because available is too high, right? So too high in correct beginning inventory. Correct beginning inventory we have here, right?
Yeah.
Purchases are too high, right? Available is too high. Correct ending inventory now gives me cost of goods sold is too high.
Okay.
And the reason it's happening is you've recorded a liability that doesn't exist. So that makes your cost of goods sold too high, your expenses too high, your net income too low, makes your equity too low, and the way it's offset is the liability is too high. Now, when we were doing earlier, it was I recorded too much inventory, right, and kept it that way. So it counts too high too. Okay, So let's go through each of these and think about what they do. Goods purchased cost. Okay, what they said was they reported current assets of 370, current liabilities of 200. So I guess we could do current ratio first on it, huh? So exercise 811. That's a good idea, probably. So we know where our base is. So they started with current assets. They want a current ratio divided by current liabilities equals 370 over 220. 1.85 to 1.
370 over 200.
Over 200. Calculations would very well like to see if you don't have the right numbers. So, okay, 1.85 to 1. Wonderful. So let's look at what each one of these does. Goods purchased costing $22,000 were shipped FOB shipping point. So when they shipped them to us, they became ours, right? They received and recorded the invoice December 29th, but the goods were not included in their physical count because they were not received until January 4th.
So
Should they have been included? Yes, because
Inventory
title
transfer.
transfer. Yeah, so we can do the same thing. Assets, liabilities plus equity. Revenues less expenses, net income. And what we would have done is we would have, we didn't include it, so we're understating this, right? We recorded the liability, it's just fine, right? So the equity's understated. How is the equity understated? Revenues are fine.
Should have had a higher ending.
Expenses must be too high because I subtracted too small a number when I did cost of goods sold, right? And made that income too low, right? And again, if you need to do this, right, because it can turn your brain inside out.
Ending inventory should have been higher, so we can
So beginning's okay, purchases are okay because we recorded the purchase, right? Okay, but then we left them out of the ending inventory. So, well, available is right, okay? Then our ending inventory is too low, which caused our cost of goods sold to be too high, net income too low, right? So that's it. That's where it came from. That's where this one came from, right there. Okay. So what's going to happen? How many dollars was it? 22,000. So my inventory is too low by 22. My equity is too low by 22. That is a current asset, isn't it?
Yep.
So my current liabilities are 370, right? They'd stay that way.
When they go
Or wait a minute. No, my current assets would go up by 22, and my current liabilities would stay the same. They did record it, didn't they?
Yeah.
They recorded the purchase, so leave liabilities alone. So all that's going to happen is I'd have current assets now equal to 392, is that right? And my current liabilities don't change because I do have it recorded, are 200. Okay? So what does that give us?
1.94.
Okay, so 1. So I think that's the second one. You guys agree with that? Oh, they did all of them. I just did one. They did all of them once.
Yeah.
Okay, so we'll do one at a time. All right, let's try the next one. How does it work?
They should have not recorded the invoice. They hadn't received the goods.
Goods purchased costing $15,000 were shipped FOB destination by a supplier. They received and recorded the invoice in December, but the goods were not included in the count because they were not received. It was correct not to include them, right?
Yes, but
But what they should have done is not recorded the entry, right? So how would you fix it? Let's just do what we would do to fix this one.
credit purchases 50,000 and debit accounts payable 60,000.
Purchases or inventory, either one, 15,000 reduction. And reduce accounts payable by 15,000. Okay, so the goods were not included in the count, right? So how would you analyze that one? You know, I have to write this down if you don't need it. Just think through it, but tell you what, you can turn your brain around so easy on these things. So what's right and what's wrong here? Assets okay? We left it out inventory, didn't we? So even if
But you recorded the invoice, so when the purchase.
so our beginning's okay, our purchases are too high, our available is too high, our ending inventory is, we didn't include it, it was right. Cost of goods sold is too high. Is that right? Cost of goods sold is too high, revenue's okay, they didn't say anything about it. Net income is too low, equity is too low, and the reason is accounts payable is too high. is what you do to correct it, right? Correct. Right? Okay. And the assets are just fine.
Doesn't affect assets. Since you got rid of purchases, would that not be an asset?
Well, you remember you adjust your inventory to the count. That's what's hanging you up. You adjust that inventory to the count, so the fact that you put in too much into purchases here doesn't really matter.
Okay.
Because you're gonna adjust to the correct account.
The only thing is that.
Yeah, but your available is still too high, so we've got 15,000 too much net income, right? Okay? And 15,000 too much liabilities. Now, what does that do to the current ratio? What would that one do?
Decrease liabilities by 50.
Yeah, you're gonna decrease current liabilities by 15, right? Accounts payable, so that'd be now 185. If we kept the original numbers, some problems do it like that. That'd be 185 instead of 200, and the current assets would stay 370. You guys with me? Okay, so what would that one be? Just if you did each one, what is it? The two
That would
exact.
be 397 for assets, wouldn't it? Are you doing it just for this problem?
No, I just do it just this problem. Yeah,
Okay.
and you could add the 22 to that. You're right. Okay, so we have the 22 adjustment to assets, and then we have the 15 adjustment to liabilities. Right? They're too high. Okay, this was too low. This was too high. So yeah, with both of them, you put the two together, you'd have obviously, I don't know, 397 divided by 185. Right? So you just keep going. Let's try another. It's kind of cool, everything. Brain teasers. The third one, goods held on consignment were included in the guild's inventory. They're held on consignment. Should they be included in your inventory? No. All right. So what they did, here we go again. It was fun. I used to try to do this without writing it down. Get myself so confused, I waste more time than writing it down. Go backwards on this stuff. Okay. So what do we think? Have I recorded everything properly? Yeah, except I just included this thing in inventory. So is my beginning inventory okay? I assume it is, I guess. Are my purchases okay? Yeah. Is my available okay? I guess so. It didn't say anything. Is my ending inventory what? It's too high, right? Too much by 13? Is that true? Mm-hmm. What happens to cost of goods sold? Too little by 13, right? You guys with me? Mm-hmm. Revenue's okay. Cost of goods sold is too low by 13. Net income's too high by 13. Equity is too high by 13, right? Is there anything wrong with liabilities? No. Right? I don't think there's anything wrong there. What's wrong? You got too much in your ending inventory because you put it in ending inventory. What you really did was you debited inventory and effectively credited cost of goods sold. Right? If it was perpetual, you would credit cost of goods sold. If it's periodic, it's really inventory change or income summary, right? Run through there. Okay? So this one, the current assets are too high by 13, right? So what would that do? It'd be 370 less 13, is that right? So 357 divided by the original 200, right? That was the only year there was. Okay, so you can do each of these. How much is that?
1.785.
To 1.0. Okay, and then we'll put them all together when we're done. So you get the same answer they do. Okay, you did it right. Number 4, freight in. Now, freight in is what? Part of the purchase price, right? So it should be debited to purchases or inventory, depending which method you're using. What if it was freight out? Wouldn't that be fun? Then they'd be okay, right? It'd be advertising expense, and it should have been,
selling expense.
Yeah, selling expense, but who cares, right? Distribution expense or something, freight expense. But it'd be a period cost, right? So it wouldn't make any difference if the problem here. But this one, you look at that and you think, well, why would debit advertising expense? A lot of times when they make a mistake, especially if it gets complex, this is a good idea to do. Here's what they did. debit advertising expense for 3,000, and I guess, either credit cash or accounts payable or something, make sense? Straight payable maybe, so eventually it'd be in cash anyway, wouldn't it? What should it be? Should have been debit what? Freight in, which is gonna be the same as debiting inventory. Either inventory or freight in, but if it's freight in, it gets added to purchases anyway. Yeah, sure. You got a debit inventory for 3, and then you credit cash for 3. Okay, what's my journal entry to fix it then? What's my adjusting journal entry? See, what's kind of nice about writing down what they did and what it should be is now you can determine what your adjusting entry is real easy. I wish I had not debited advertising expense. Would be a good idea to fix it. Remember when I did this to principals? It's credited, right? You know, you didn't want the debit, get rid of it, credit it. So that one's gone. Cash is okay, I like cash, I can leave it alone. What do I want to do? Debit inventory, okay, for 3. So what will this do, okay? What is that gonna fix? That's all we gotta do.
The equity would go up by 3 and assets would go up by 3.
Absolutely. You're going to increase the inventory by 3. So right now it is understated. It's too low by 3. I think that's how I wrote them all, wasn't it? Too low by 3. Liabilities are okay. Equity must be too low by 3. That's because net income is too low by 3. And the reason is advertising expense is too high by 3. Right? That's what's wrong now. So to fix it, what are you going to do? You're going to be increasing your current assets, right? So my current assets just for this one would go to 373, right? We just did this one separately, okay? So I'm going to increase it to 373. I'd still be at 200 for my current liabilities because there's no liability in this one. And what does that come up to?
1.865.
To 1. Okay, so you could do them. If it asks for them independently, you could do that, of course. All right. So let's figure out all 4 of them together. Okay, let's add them up. What do we have? The first one is 22 more assets. So if you took you do it like this. Assets equal liabilities plus equity, right? Oh, and we went to the income too, though, didn't we? Although the equity can all be income. So we can just do it that way, right? You don't have to do the revenues, expenses, cost of goods sold. Okay, so the assets would go up by 22 in A, right? And the equity goes up by 22, right? And that's going to change my current ratio, of course. That was the first one we just did. Okay, the next one, the liabilities go up by 15 and equity goes down by 15, right? Is that right? Liabilities up by 15. No, the liabilities are too high. Liabilities down by 15. And equity up by 15. So the second one, liabilities go down by 15. Equity up by 15, right? Just make sure both sides balance. The third one, that's the advertising expense. It's 13. Okay. This one made inventory was too high by 13, so we need to reduce the current asset by 13 and increase net income is too high. Reduce net income too. So equity goes down and assets go down by 13. Is that right? Both are down by 13. Assets are down by 13. Net income, therefore, equity down by 13. Big ramp, right ratio. And then the last one on the advertising expense, we said assets should go up by 3, and advertising expense equity should go down by 3. Both up by 3. Assets up by 3, and equity up by 3, right? What do we have? 22 plus 16 is 38. And
Oh, yeah.
is 9, plus 3 is 12. Okay, and this is decreased by 15, and what happens to net income? Let's see, 37. Up 22, up 22, down 15, up 15. Oh, up 12, down 15, it is 27, isn't it? Gotta be up 27. Yeah, I can't add. 27 less 15 is 12, right guys? So net income's up by 27. Current assets are up by 12. Current liabilities are down by 15. Let's add them up. 22 plus 15 is 37 less 10, or less 13 plus 3, right? So there's another 10. So 27 less, 37 less 10 is 27. Work, didn't it? You guys good? Okay. Why is it taking so long? I don't know. Current assets divided by current liabilities, what do you get? So 12 added to 370 plus 12.
Yeah.
382. 200 less 15 is 185. And what do we get? 2.06. We are brilliant people. Okay, slow but brilliant. Okay, and what happens to net income? Well, understated by 27. Is that right? That direction we want to go? They agree with us. Look at that. There's a 2.06. Brilliant. I did exactly what we did. Oh, it's 24. Ah! How do they get 2.06 and it doesn't change? Overstatement of advertising expense, understatement of cost of goods sold. Did the last one wrong. I changed the income, but I did go to equity. 4. Freight in was debited to advertising expense. They are assuming that it was the ending inventory was properly priced, including that 3,000. We just assumed that they didn't include inventory. Did it say the ending inventory was priced correctly? No. So our assumption's as good as theirs. Maybe better. If you debited advertising expense, if you debited advertising expense, would you remember to add it to your inventory? Probably not. If you put it in advertising expense, you probably wouldn't remember to put it in inventory. If you put it straight in, you probably would. But it's possible, of course, to price the cost of the inventory, including it, right? When you value your inventory, you do the invoice price plus any other freight in and taxes and so on, right? So it's possible to do it the way they did. But I like our answer just as well, don't you? See why it's different. Yeah, you know, but if they picked it up and put it in the inventory, right, what would change on what we did? Good to look at. What would change here if we think they put it in the inventory, right? Which is what they meant to do. If we think they put it in the inventory correctly, then our cost of goods sold would be what? Too low, right? This one. Getting inventory plus the purchases, what is available, less the ending inventory. It's cost of goods sold. And what they're saying is, I would have had the right number here. Our purchases, including freight in, because the freight in goes in there, right? Would be too low, right? And available would be too low. And then if the ending inventory is correct, I would think your cost of goods sold too low, right? So advertising expense would be too high. Cost of goods sold would be too low. And the journaling to fix it would not be this. What would it be? If I do the inventory correctly, right? What would it be over here? Not debit inventory and credit advertising expense, would be debit cost of goods sold. Okay? one, exercise 8.1. Did you do that one? Big long list of them.
Yeah.
So presented below is a list of items, page 452. Presented below is a list of items that may or may not be reported as inventory in a company's December 31st balance sheet. Goods out on consignment at another company's store. Our goods are at their location. Yes, they're part of my inventory. How about goods in on consignment from them? No, you would not include them. So they say number one should be included. Yeah. Two, goods sold on an installment basis. Bad debts cannot be reasonably
They
estimated.
said can be.
Oh, can be. Oh, all right. So is that a sale?
Yes.
Yeah. So cost of goods sold should be on the income statement. It should not be inventory, right? You debit cost of goods sold and credit inventory, right? How about if it cannot be estimated? Then it should be part of your inventory, right? Okay, got it? You got to read carefully. Goods purchased FOB shipping point that are in transit. The title I purchased them. The title transferred to me when they shipped it. They're mine. Should they be included in inventory? Yes. They agree with us on that. How about if the goods were purchased FOB destination, as in number 4, and they're in transit? No, they're not mine until they get here, right? So those would not be included, not reported at all in the financial statements. And you don't have the inventory, you don't have the purchase, and you don't have the account payable, right? You don't owe for them either until you take possession of them. Okay? All right? How about goods sold to another company? Well, let's do this. Let's have shipping point later. Let's do them now. If you look at number 7, goods sold FOB shipping points that are in transit. Those are no longer ours. We debit cost of goods sold and credit inventory, right? So on number 7, notice they say cost of goods sold in the income statement. Okay? And how about goods sold FOB destination that are still on their way there? That's number 17. That you would not record the cost of goods sold yet. It would still be your inventory. So that's included in inventory. So notice they got that 7. Number 17 should be included in the inventory. Okay? They're easy, aren't they? If you just let yourself relax and think about it. Seen stuff like this on CPA exam questions over the years. Lots of them. Okay. All right. So we're down to 5, I guess. Goods sold to another company for which our company has signed an agreement to repurchase at a set price that covers all costs related to the inventory. That's our inventory. There's no sale, there's no cost of goods sold, there's no receivable, right? There's no reduction of inventory. That's your inventory. Okay, and there's no transaction. That's just like consigned inventory, right? The agreement to repurchase like that. 6, goods sold where large returns are predictable. I can set up an allowance for sales returns and allowances, can't I? Right? So it's just fine. Okay? So what am I going to do then? Go ahead and record the sale and the cost of goods sold. Keep that. Just have a cost of goods sold, credit inventory, debit accounts.
Would you, it would be like sales returns and allowances?
Yeah, and the way that could work is, it works.
It's like a contra revenue.
You got it. It works just like allowance without penalty. What you do is you would debit your estimate to sales, returns, and allowances. And what you're trying to do is get good matching, right? Just like you debit bad debt expense, you get the bad debt expense in the period you have the sale. You debit sales, returns, and allowances.
The revenue would be smaller, wouldn't it?
Well, it's going to be sales, less sales discounts, less sales, returns, and allowances. So to the extent you're increasing this contra revenue account, yeah, your net sales are lower, right? Wouldn't change your gross sales, but your net sales are lower. Okay, and then we're going to have an account called allowance. It's crazy. For sales, returns, and allowances. Okay, and that is the contract asset. Okay, so as this goes up, your net receivable goes down. So on the balance sheet, you would show, and on the income statement, be like this. You show accounts receivable, less the allowance for doubtful accounts, right? And also less the allowance for sales, returns, and allowances. Okay, got it? So I'd have two of them coming out of here, and then that gives me my net accounts receivable. Okay? And then on the income statement, I'd have my sales, less my sales discounts probably. I have them.
Plus your sales.
Sales, returns, and allowances. You got it. And then bad debt expense would be down below, right? That'd be my net sales. And down under operating expenses, I'd have bad debt expense. Good. Okay, go with this last stuff. Okay, did I do it? Cool. All right.
While you're looking at that, will you go ahead?
Oh, go back to the problem.
Just to the last page. No, no.
The previous, like.
What you just did with the balance sheet.
Oh, I apologize. Okay, so then the next thing we've got, do you have a question on it or just?
No, I just wanted to write it down.
And what would the journal entry be for the bad debts, by the way, guys? You have a bad debt expense and credit allowance, right? Yeah, that's how that gets there, okay? Now you guys know that. This is getting so you can learn it quickly. Isn't that cool? I mean, you understand the model works and what the relationships are in the financial statements, and each new thing is kind of like something you already did before. There's just accruals and deferrals and cash transactions, that's all there are. So.
What does it say? It says income statement, sales, and what?
Sales, less sales discounts, less sales returns and allowances. You can't read that for crying out loud. And net sales. And on the balance sheet, it's accounts receivable, less allowance for doubtful accounts.
I got all
less allowance for sales returns allowances. Yeah, and on the balance sheet, those two allowances are contra assets, right? And on the income statement, the sales discounts and the sales returns and allowances are contra revenue accounts, debit balances, huh?
What are you debiting or the bad debt expense at the bottom for?
Oh, it's down under operating expenses on the income statement. Down, included in your operating expenses is bad debt expense. Okay? The journal entry would have been, for bad debts, would have been debit bad debt expense, right? Or whatever it is. And credit allowance for doubtful accounts. True? Okay. But that's where the bad debt expense goes, and here's where the allowance goes. Well, there's the allowance. Okay. We're doing exercise 8-1. Talk about what goes in inventory. We did 6, we did 7. 8 is 8, or did we do 6? Yeah, that's what it is. 7 we did too. FOB shipping point, goods that are in transit, and they're sold. So it's FOB shipping points, we should record the cost of goods sold, right? It's not part of our inventory. Let's go back. Okay. So for number 7, cost of goods sold on the income statement. See it there? Okay. You agree with them? Freight charges and goods purchased is part of my inventory, right? Should be added. Freight charges on goods that are sold should be what? Goods that are sold. Freight delivered. That's operating expense, right? Okay, I don't know if we have that one in here or not.
I was going to say, where did you just get that?
I just made it up. Okay. So if it's freight in, it's part of your inventory, and then until you sell it, then it's part of your cost of goods sold, right? All your inventory becomes cost of goods sold when you sell it. Okay, and freight out is always operating expenses, right? And it makes sense, right?
It would fall under like selling with it.
Selling, yeah, selling administrative, distribution costs, delivery costs, something like that. You can call it freight out if you want. Have a line of operating expenses for freight out, it's an operating expense. And you can call it freight in on the freight in, it's fine, just make sure you put it up in the cost of goods sold, okay? Let's see. Interest costs incurred for inventories that are routinely manufactured, that's a hard one. I make these all the time and I have interest costs.
Just the interest expense.
It's interest expense, yes. Okay, now, I have a special project like building a house, building a bridge, right? And I'm building it over a period of time as an individual project. Now what do I do with the interest during the period of construction? You add it to the inventory, right? During the period of construction. As soon as you're done constructing it, what do you do with the interest? Start expensing it, right? But usually on those deals, you deliver the goods to somebody, right, when you finish producing it, right? They're waiting for it, and you do it in special order that way. Okay, so it's a big difference, isn't it? Okay.
So it would be a no.
So that one would be, we want it to be interest expense in the income statement, so not there, right? Interest expense on the income statement. But if it were for a special project, you'd go the other way around and say, I'm going to add it to the inventory, okay? Costs incurred to advertise goods held for resale. That's advertising, right? Okay, oh, advertising expense in the income statement. Materials on hand not yet placed in production by manufacturing firm. Raw materials inventory, yes, it's inventory, right? So that's raw materials inventory. Yeah, it's inventory. Office supplies. It's a different current asset, isn't it? Is it part of inventory? Well, yeah, some people actually do it. Yeah, but what should merchandise inventory be? Stuff you're going to sell to somebody else. So inventory, the account, inventory, merchandise inventory is stuff you're holding to sell to somebody else. If you're going to use it yourself, it's called a supplies inventory. So that's what they say there too. It should be separate if office supplies and current assets section of the balance sheet. So you put it down below inventory probably, right? It's going to be a relatively small number, of course. Okay, we'll compare that to factory supplies in 14. I am going to use those supplies in manufacturing my product. They are going to either become part of the product, which more raw materials become part of the product. What do factory supplies do? We use them up, but it's in the process of manufacturing, right? So what are those? Overhead costs that are going to be applied into the manufacturing process, aren't they? Right? Remember that from 102?
Did you just skip 13?
Yeah, skipping on purpose. Okay. So what's the deal with the factory supplies? They become part of the inventory. What's the deal with the office supplies or sales supplies or something? They're administrative expenses. Got it? And they get some.
What's 13 be like work in process? Well, it's like managerial, but...
Well, the other thing on 14, is it part of your inventory? Yes, because it's like raw materials inventory, right? Same sort of idea. 13, raw materials in which the manufacturer has started production which are not completely processed. Is that part of the inventory? Sure. Work in process. That's exactly right. Materials, labor, and overhead built up on. Good. Goods held in consignment from another company. They're not ours, they are theirs, right? So 15 is not part of the inventory, not recorded at all. We don't have a payable, we don't have anything with it, right? We of course you keep track how much you have there. Costs identified with units completed by a manufacturing firm but not yet sold. That's inventory, it's called finished goods inventory, right?
Yeah.
Okay, good. Goods sold FOB destination and transit, we did that one. It's FOB destination, have we sold it yet? No, so it's part of our inventory. 17. Short-term investments in stock and bonds will be sold in the future.
That'd be like trading security.
Yeah, thank you. Yeah, that's marketable security. Yeah, trading security, near future trading security. Yeah.
Inventory and trading security.
Yeah. So that's all right. What
Stock
else?
inventory.
Yeah. Right. My inventory is stuck. You want to do some inventory errors? Want to value some inventory? I don't care. This is a pretty easy chapter.
Can we do another inventory error?
Sure.
I don't know what you all did before I got here, but...
We did 311, didn't we? You want to do one where you actually crank the numbers again?
Something like what you're going to give us on page.
Yeah. I printed it up this afternoon. I don't know what it is anymore. Too long ago.
Just some numbers.
Let's do this. Let's do 8.5. We think that one's good. Exercise 8.5. Determine the proper inventory balance at December 31st, 2014. Prepare any correcting entries to adjust inventory. So do that one. Go ahead and do it. We'll get a drink of water. 8, exercise 8.5. Thank you, Kenneth. Wake up. Yeah.
It's reading the problem.
This one's enough to drive you a little crazy. And write down each one as you know it. Just take that opening balance they give you, or the balance that it is, their physical count, right? Prepare any correcting entries to adjust the inventory. Assume the books have not been closed, but they didn't give you an opening balance in inventory, so what you probably think they've done. Adjust to that balance already been disposed. I bet they already have 234,890 in the account, don't you think?
Yeah.
You're going to adjust that number. So you can do a T account if you want for inventory and put it in there and then do all your debits and credits to it. That would work. Bob's read at Kennedy Elementary School. It's a fun day. Oh gosh. Elementary school. He was shooting at the police office. Any type of deal.
Yeah.
He went back to the back bus.
I just want to see how you miss a bus. That's my thing.
You're talking on your cell
Yeah, they're
phone,
probably
or you're
texting.
texting, calling, or reaching down to get a CD, although people don't play CDs anymore, do they?
Almost read it somebody the other day.
What do you call them?
MP4.
You don't even use those much anymore. Now it's
It's just on your phone.
yeah, it's just from your phone. So you get your phone hooked up and play music.
Well, you should do
Pandora or
that
something.
before you leave.
Almost read
You
it
would
somebody the
think
other day.
so, or stop your car and park if you want to talk on the phone. What we need is illegal everywhere, and $1,000 fine.
I was
It
driving.
wouldn't change anything. People would just find a way to do it without.
Well, you can have hands-free stuff, you do that.
Trying.
That's just as
Come up with
dangerous.
the
But you know what? The kids yelling in the backseat are pretty dangerous too.
Yeah.
Back. Yeah.
I was driving the other day on Easter, and somebody like in front of me just straight like threw on their brakes, like did a complete stop. I like threw mine out, like threw me forward into my seatbelt. My car like skidded because I had to brake so hard. And I was like this far from rear-ending him.
That's how I totaled my car.
Yeah, they just like straight up stopped in the middle of the road.
But it was the bus's fault. The bus decided he was going to slam on his brakes.
Yeah, that's what they did. Like I was behind and they straight like stopped.
That's like when,
Blame the bus driver.
can I tell you always say farther back? Oh, I was
surprised
surprised very far away.
Was that enough defensive driving that you could right? Was it defensive driving? Could
I didn't hit the
avoid
bus.
it?
I hit the car in front of me. She almost hit the bus.
Yeah.
We were only at 35. We weren't going super fast. The bus went from 35 to 0 real
We're not
quick.
gonna let you get away with rationalizing. My daughter did that. She
Not my
rear-ended
car
somebody,
fixed out of it.
but it was their fault. They swerved in front of me, and the police said it was their fault too. And she
The
said, I don't
police
care
said
if it's
it
their
was the bus's
fault.
fault.
You still wrecked the car. Don't run into them. Okay. Anyway, so let's you ready to give these a shot? Figure them out.
2 minutes.
2 more minutes. Okay. Just wasted a couple minutes of your life. That's good. Talk about something else. Not fair. These other people's office windows open, classroom windows open, or something. My office windows don't. Get that strange one that sticks out a little bit. I don't know why it did that. Use that stained glass. Yeah. You get your letter done, send it off.
I submitted it online and sent it to Steve and Jack.
You need 11.5 points.
I didn't change it out.
It's fine. I don't know, maybe that's easier than 10. I know 11's a lot easier on me than 10. 10 is too small.
Yeah.
Pull the paper up your face.
Well, 100%.
And 12 makes it look like you're third
fine.
grade. You know? Yeah, so. Yeah. So maybe 11.5 is a new thing. Do they want you to your resume 11.5 too, or do they like to call
They
it
didn't
11?
say anything. She didn't like my resume at all, so.
Why not? Yeah, so. You didn't tell me you were going to get everything. Don't do that in your resume. Just tell me you've done.
You have to believe that before you can do it, right?
No, even if you believe it, don't do it.
Well, I don't believe it, so.
If you believe it, get some counseling. I am the best person on earth. Hire me. I don't think so. Yeah, they're just sitting there staring at those.
I'm finished with the inventory. I'm just doing the journal entries now for the incorrect ones.
You only need one journal entry. One entry. Don't do a whole bunch of entries.
Well, I was just like looking at each. I'm not doing like a bunch, but I'm like checking each problem because it's like different ones.
Yeah.
Writing them all out, and I'll just make one big.
Oh, if you were working for it, you could do that too. You know, if I had somebody make 5 or 6 journal entries, they could have written one. Why would you do that?
So people aren't as talented as you two.
Well, that's it. Not as lazy as me. Do extra work for me. Nobody could take that long.
Maybe when you're flipping back
What
and
would you
forth
debit?
between pages.
Yeah,
Would you
there's
debit?
8.5 right there. And it says it's supposed to take you 15 to 20 minutes. So, all right, fine.
What would you debit? I know you credit the inventory, but if you included like consigned goods, would you?
Yeah, you've included consigned goods in your inventory, you've already adjusted your inventory. So you credit your inventory, right?
And
take it out. And
accounts payable?
if you are, let's see, you included consigned inventory, probably didn't do it that way though. What you did was you added it to your inventory. So your beginning is okay, your purchases are okay, your ending is too high, so your available is right. Your ending is too high, which makes your cost of goods sold too low. So if I'm professional, I'm going to debit cost of goods sold and credit inventory, right? If I'm periodic, because I should have more cost of goods sold, because I've overstated my inventory, right? Okay? And the same effect would happen if I'm periodic, but it would go to income summary, right? Because my adjusted income summary would have been wrong when I adjusted my inventory. Does that make sense? Okay. Are we good? Got something down? Got a journal entry? Do your journal entry yet? Please. Everybody's got so much energy today. Probably a reflection of me. Should we give it a shot? Unanimous. No response. We're putting the people to sleep at home. Okay, let's give it a shot. So I think they'd start with that 234,890. You guys think so? I think. Didn't say that you hadn't recorded it, and you got to have something in inventory, huh? So it looks like the 234,890 was on hand at December 31st, 2014, and therefore I would assume that they adjusted their inventory. They didn't give us an opening balance. If they had, we could have taken their opening balance and adjusted it to where to 234,890. But I think it's probably already. Wouldn't you think so? Not included in the physical count of inventory is 13,420 of merchandise purchased on December 15th from browser. It was shipped FOB shipping point on December 29th. Okay, so we purchased it on December 15th. It was shipped December 29th and arrived in January. The invoice arrived on time and was recorded. So they did debit purchases. Do they say if they're doing periodic or perpetual? They don't do that.
No, these.
Yeah, so they either debited purchases or they debited inventory and they credited accounts payable, right? Okay, but then when you counted, you did not include it, right? So again, we can do this if you want.
On one, would you just assume, because the first and five words says Craig uses the periodic method of reporting.
Oh, it is there. It's periodic. We don't have to mess with it. I thank you. I missed it. Yeah, if it's periodic, it would be debit purchases. Right? But it's not going to make any difference.
All the way through then, or
Yes.
just for
Yeah, I keep it all the way through. Thank you. So it is periodic. Good. I like it better when they tell me, because then at least I know which one it is. I don't have to try and do it both ways. And so it really wouldn't make any difference anyway, typically. But in the final outcome, because the process is different. Okay. So if we use this for them all. I have to keep these things straight, I think. There we go. All right, guys. Not included is 13,420. So what do we want to do? We want to include it, right? So I'm going to increase the inventory by 13,420. But what's wrong? I'm missing, because you got to the other side of the entry, right? It's going to be debit inventory. But what's wrong? If it's periodic, what should I have done? I did debit purchases, right? It's okay. I did credit accounts payable, it's okay. What I did was, and my beginning would be okay, so my available is okay, but what I did was, when I counted the inventory, I did not include it. So I'm too low by 13,420, right? Which makes my cost of goods sold too high by 13,420. My expenses are too high, revenues are fine, net income would be too low, wouldn't it? You guys agree with that? What he means. Net income's too low, which causes equity to be too low, and that's caused by the assets being too low. Yeah. So what's the journal entry for that one? Debit inventory and credit. It's periodic. No, we recorded it.
Oh, yeah. Debit inventory.
If we want it, we're going to take it out of cost of goods sold, but they don't have a cost of goods sold account. Because it's periodic. What does it come out of? When you adjusted your inventory from where it was to where it should be at the end of the year, right? Where it was in the books to where it should be. Remember with periodic, you left it where it was. You got a purchases account, right? So I got a purchase account, but the purchases have the right number in it.
Oh, yeah.
What do? You credit the inventory for the beginning balance and debit income summary. Then you debit inventory for the ending balance, right? And credit income summary. The inventory change ends up where? In income summary. Gosh, you guys. So that 13,420 is going to be a credit to income summary, debit inventory, right? They already adjusted their books. Remember on periodic, it runs through income summary, doesn't it? I don't know if they do that on their journal entry or not. It is going to hit cost of goods sold though. Now, if they use a cost of goods sold account and they close purchases already and the inventory change into cost of goods sold, then it would go to cost of goods sold. So we'll see if our entry agrees with theirs. But it says periodic, so that's the way it goes. Let's try the second. Number 3. Included in inventory is merchandise sold at Champy FOB destination. The merchandise was shipped after it was counted. Uh-oh. The invoice was prepared and recorded as a sale on December 31st. Is that okay? The merchandise cost $7,350, and this is periodic, so they are not recording any cost of goods sold, right? There's not going to be a debit to cost of goods sold and credit to inventory, right? The way you do it is you adjust the ending inventory for it, don't you? So they included in the inventory. Should they have? No. So did you guys take it out of here? And so what I want to do on this one is I want to reduce, right? I've overstated my ending inventory by $7,350, right? So now I've got too much in here. If I have too much in there, what does that do to me? Think, guys. You subtract too big a number, that gives you what? Too little cost of goods sold, right? Too little cost of goods sold will give me what? Too high a net income, which will give me too much equity. And the reason I have too much equity is I have too much assets, right? Everything's good otherwise, isn't it? Okay? So that's going to be credit over here. What's the debit going to go to? Of course, seeing as it was part of my inventory adjustment at the end that was screwed up, right? Right here. That's what I think it should go to. Now, they may put it to cost of goods sold, but that's where it'll end up anyway, right? Go to income summary with it. Because you know what's in income summary here? It is the difference between the beginning inventory and the ending inventory, right? That's what ends up in income summary, right? The inventory change. Okay. What's the fourth one, maybe, I guess? Included in inventory was merchandise received from Dudley with an invoice price of $15,630. It was shipped FOB destination. The invoice has not yet arrived, has not been recorded. Should they have included this in inventory? Seeing as it's FOB destination, who cares if it's FOB shipping point or destination? It's been delivered, right? We have it on hand. Is that our inventory? Of course it is, right? It's received from them. And it is $15,630. So do you think the inventory is okay? Yeah. What's not okay? What do they need to do to fix this one? I think
Wait, you did 3 wrong. 7,350 is included in inventory. It's FOB destination, not shipping point.
But it should not. Oh, wait a minute. Oh, it's sold to an FOB destination, the merchandise was shipped after it was counted. Oh, I did do it wrong. It should be left in inventory, I read it wrong, didn't I? Should be left in inventory. That's okay. But they recorded a sale, didn't they? Right? The invoice was prepared and recorded as a sale on account. So what they did was they debited accounts receivable, credit sales. So what do they need to do to fix that?
Debit sales, credit, accounts receivable.
Yeah, thank you. So sales needs a debit of 13,
That was 73.
75. Because it's too high, isn't it? And what do you want to credit? Accounts receivable. Fix it. Good job, Keith. There you go. Okay. Thank you. Did you have a write on your paper there?
Yeah.
Try to let the doc out of it. Okay. All right. So good. I agree with you. 4. What do we have with 4? Included in inventory is merchandise received from Dudley with an invoice price of $15,630. It was shipped FOB destination, and we got it, and that's fine. The invoice has not yet arrived and has not been recorded. So what do we need to do?
No increase.
We included in inventory, so no change to inventory, right? But what do we need to do? I need more accounts payable, don't I?
Wait.
Invoice price of 15, it was shipped, right?
FOB destination, but so there's no invoice yet because it hasn't arrived yet.
Well, no, it arrived on December 31st.
Oh, it did. Oh, okay.
We put it in the inventory,
Okay,
we're
yeah,
happy
yeah,
about
yeah.
that, and we put it in what? We put it in the physical count of ending inventory.
No.
So ending inventory is right, but we failed to record the purchase. This is, what method are we using, you ask? Periodic. What would the debit go to? Purchases. 15,630.
Yeah.
And credit what? We haven't recorded. Accounts payable. We have a lot of accounts going here, don't we? Okay, that's what should happen.
8,540. 15. This is 5, right?
We're not at 4. That's 4. Thank you. Okay. So this one is 2, right? Three is 7350, right? 4 is 15,630. There we go. You guys good? So 5, I guess. Not included in inventory is 8,540 merchandise purchased from Gloucester. The merchandise was received December 31st after the inventory was counted. The invoice was received and recorded on December 30th. It was received December 31st, though. Should it have been included in the inventory?
Not on the 30th. It should have been.
Well, our year-end's December 31st.
Yeah.
The invoice has already been recorded. It shouldn't have been recorded yet, but at the year-end, that's fine. We don't care, right? So they debited purchases for this amount, 8,540, and credited accounts payable. That was okay, right? Our purchases are fine. Okay, it's not included in inventory, though, so our ending inventory, is it too low? Yeah. So we got the same thing. Ending inventory is too low, causes cost of goods sold to be too high, right? Which causes what? Net income's too low, equity's too low, and what's the other side of it, though? Not included in inventory, it's got to go into inventory, right? So this is going to be debit inventory for 8,540, and what is it going to be credited to? Yeah, if they just left it out in the inventory, hit income summary, wouldn't it? Same deal. So that change in inventory would be screwed up. I think. Okay. Number 6, included in inventory was 10,438 of inventory held by Craig on consignment from Jackville Industries. So should that be in the inventory?
No.
No. So we need to take that one out. So 7 we'll take out. This is really something. 8, 10, 438. Wait a minute. I'm at number 6, not 7. 10, 438.
Mhm.
Excellent. And what are we going to debit? Let's see. What they did was they overstated the ending inventory, didn't they? All right? Everything else is fine. Right? Beginning plus purchases plus it equals available. It's all fine. Subtracted too much, which makes cost of goods sold too low, which makes net income too high. Right? Whoops. Yeah, cost of goods sold too low, net income too high. Equity too high. Right? Because the inventory is too high. So how am I going to get it out of here? 10,438 comes out of inventory, but what did I screw up? The ending inventory, and I adjusted to that, so it's going to be right here, isn't it? It's going to be the income summary. I heard that over there. Fantastic. That's exactly what I think it is. Or cost of goods sold if you were perpetual, right? All that would be cost of goods sold. All right, adjustments here. So 7. Included inventory is merchandise sold at FOB shipping point. The merchandise was shipped after it was counted. The invoice was prepared and recorded as a sale on December 31st. It was shipped that day, right? Yeah. So is the sale okay? Debit accounts receivable, credit sales. Yeah, we're happy with that, aren't we? It was shipped, I think, right? It's FOB shipping point. The cost of the merchandise was $10,520, and Kemp received the merchandise on January 5th. But it's FOB shipping point, so the sale should be recorded. It was. But the cost of goods sold, has it been recorded? No, because you left it in inventory, right? You should have segregated and moved it and not included it. So what do we do with 7? Take it out of inventory, right? I think. 10,520. So I should have less inventory. It's the same deal, isn't it? I should have, my ending inventory is overstated, which makes my cost of goods sold understated, right? Okay, I should have more cost of goods sold. That'll give me more cost of goods sold, which, so,
Receivable.
what's that?
You have a receivable for 2,520?
Well, no, because how would they have recorded the sale for 18/9? It was shipped December 31st, right? And they recorded the sale December 31st. They would have debited accounts receivable and credited sales. Are we unhappy about that? No, that's fine, right? If I'm reading it right. That's fine. Okay. But what about the 10,520 though? Did they record anything? No. And remember, they're periodic, so they're not making a journal entry.
So it would be
Anyway.
it's sold if they debit.
Well, huh? Income
yeah,
summary.
income
It's going to go to income summary because we are periodic.
But
If we were perpetual, it'd be debit cost of goods sold, credit inventory. So I'm going to credit inventory, taking it out, right? And it's going to run in here. 7, 6, this is 7. Okay, sure. 10,520. Okay, it's going to end up in cost of goods sold anyway, right? Because all this income summary stuff, remember, is beginning inventory less ending inventory. We're adjusting that, aren't we? Okay, so we're changing it. As you change the ending inventory, you are changing cost of goods sold, right? Periodic. Okay. Number 8, I guess. Excluded from inventory was a carton labeled, "Please accept for credit." This carton contains merchandise costing $1,500, which has been sold to a customer for $2,600. No entry has been made on the books to reflect return, but none of the returned merchandise seems damaged. And I guess we're taking it back. So what should we do with this one?
Add it back to inventory.
Yeah, we should put the 1,500 or the 2,600?
1,500.
1,500. Debit inventory, 1,500, right? So that one's going to be 8. And then what's the credit going to go to? I'm adding it to the ending inventory, aren't I?
Cost of goods sold.
So it's going to be the same thing. Cost of goods sold, which is income summary. You got it. Okay? That's for the 1,500. I think that's true. But what about the return?
You have your each sales returns.
You got it. Excellent. Sales, returns and allowances is gonna be debited, right? For 2,600, or you could debit sales, right? If you want to undo the sale, but sales returns allowance is more likely. And then what? What did it come out of? They owed you and now they don't.
Credit receivable.
Accounts receivable. 2,600. Oh my gosh. Okay, and that's also part of 8. So 8 has 2 of them. You guys good? Can you write a journal entry now? Yeah. What's the ending inventory supposed to be? See if we got the same number they did.
237,392.
237,392.
That's what I get.
Okay. Did you guys get that too? We know what we want to do to sales. We know what we want to do to purchases. We know what we want to do to accounts payable. We'll add these two together. That looks like 10,950. Is that right? And then we'll make sure our journal entry balance is 2,600. And then income summary, you got to figure that one out too. It's kind of fun. 6-minute wait. 13,420 plus 8,540 plus 1,500 less 10,438 less 10,520. What'd you get there? No. What'd you get in the income summary?
No, I didn't do all this. Didn't this? Just that's
We have to make a journal entry.
Yeah, I did all the testing entries, but I didn't. I had done them like individually, like as I went along. Yeah.
You're gonna post all that stuff. I don't know, maybe they did it separate too.
2502.
Credit.
Yes.
How are we gonna make sure our journal entry balances? Add this debit. Whoops, I'm sorry, the difference on that one. 234 down to 237. How much is the debit to inventory? The combined debit of all those. The 234, we're assuming is already in there. So it's less than 3,000. How much is the debit inventory? See what I'm doing? 237, 392 less 234, 890. Your net debit to inventory is all added up, of course. How much is that? It's 2,502. How about that? Why did that happen? That one, the same number, right? Periodic, yeah. Okay, to the other end, does the rest of it balance? Debit purchases, credit accounts payable does, right? Debit sales returns and allowances, credit receivables, debit sales and credit receivables, right? They all balance, don't they? Okay, so we could group them. We can make it one big entry, so let's do that. Kind of a useful thing to do too is to see these there we go. Is to see the journal entries all come together, right? Make them one. That's not bad. Debit inventory, how much? What do we say? 2,502. Right? And what else do we want to debit? You can credit income summary if you want. 2,502. What else do we say we're going to debit? Sales. 7,350. Right? We want to credit accounts receivable. The account receivable is going to be 7,350 plus 2,600. 10,950. Look good? And then what are we going to have? I think it'd be sales returns and allowances. 2,600. Okay, good. And then what? Purchases and accounts payable, right? 15,630. Know what your guys' journal entry look like? Get the totals to look like that, maybe. Is that everything, everybody? Okay. So let's see what the authors did. So take a peek at this. Look at that, they did every single one of them independently. No, that's in page 4. That's in page 4.
They agree with me.
327,392, is that what we got? Yeah? That's what we got, okay. So they reversed the sale on 12/8, did we do that one? They got the purchase. 12,800 sale they're reversing.
We did the 7350, not the 128. It's in number 3.
Materials cost, they didn't do that one? Uh-oh,
Which one is it?
Number 3.
that's all.
Number 3?
Well, number 3 is a problem.
If they say transaction 3, materials costing 7,300 were returned to the supplier and were shipped FOB shipping point. The return date was. Where'd they get 12/8?
It's in number 3. It's in
Yes.
number 3.
Included.
Invoice was prepared and reported on sale amount for 12,800. Merchandise cost 7,350.
Mine doesn't have the 12/3 in it, I'm not kidding.
The 12/8.
Number 3 is the 12/8. It says materials costing 7,300 returned to supplier on December 29th were shipped FOB shipping point. Return was
You're looking at E84.
Oh, that's why. Okay. I'm sorry. Including inventory as merchandise was shipped. Was prepared and recorded as a sale for 12/8. Oh, I did it for the wrong number, didn't I? God, geez, terrible. So, yes, that one was 12/8. Read it right. Read it wrong. You guys didn't tell me either. Horrible people. Okay, so 12/8 plus 12/8 here instead. So over here it's 12/8 plus 2,600 is 15.
15.4.
15. No, it's 15. 15.4. Okay. All right, let's see what else I screwed up. We did this one right, didn't we? Purchases and accounts payable. We did that one right. And that was it? Did we do more than they did?
Yeah, we did the inventory and the income summary.
Oh, and they never did that, did they? Oh, they're assuming that they haven't closed the books yet. They haven't done their inventory adjustment yet. Yes, you have. Because they're wrong. Because they have the 234,890. They can't have that unless they've done an inventory adjustment already. Unless that's last year's inventory, which it's not, right? You put it in the counter. So we're right. They're wrong on that one. So you screwed up 1. They screwed up 3 and 4. Go away. This is an easy chapter. In a way. In a way. Yeah. All that crap. It's kind of like in this course, the chapters are either full of a whole bunch of stuff that aren't too hard, or they're just hard and there's not as much stuff. The next chapter, there's not really as much stuff. Oh my.